The crypto community has been buzzing with excitement for years, expecting 2025 to bring the next big bull run, a repeat of Bitcoin's historical four-year cycle, driven by the halving and institutional adoption. But recently, macro investor Raoul Pal, one of the most respected voices in global finance and cryptocurrency, delivered a message that shook those expectations. The 2025 crypto bull run is cancelled. I'm sorry. His statement isn't meant to be sensational, it's a sobering reminder that markets evolve, and so do their cycles. In this script, we'll dive deep into what Pal means, why he believes the traditional crypto cycle may be broken, and what this could mean for investors moving forward. Raoul Pal, a former Goldman Sachs executive and co-founder of Real Vision, has built a reputation for connecting the dots between macroeconomics and digital assets. He was among the earliest mainstream investors to recognize Bitcoin's potential, often using liquidity cycles, global money supply data, and business cycle indicators to predict market trends. But now, instead of predicting a classic parabolic rally in 2025, Pal believes the cycle has changed, delayed, stretched, and reshaped by new macroeconomic realities. In his latest analysis, he argues that the familiar four-year crypto rhythm, having accumulation, breakout, and blow-off top, no longer applies in its old form. The world economy, he says, is operating on a longer business cycle, and that shift is spilling into crypto markets too. According to Pal, several factors are at play. First, he points out that the business cycle has been extended. Debt maturities, which used to average around 4 years, now span 5 or more, pushing back the timing of liquidity waves. This means the flow of capital that typically fuels speculative risk assets, including crypto, arrives later than expected. Second, Pal emphasizes that macro forces, not just Bitcoin's halving, are now the primary drivers of price action. He believes that global liquidity, central bank policy, and fiscal stimulus have become far more influential than on-chain events alone. The halving may still matter, but its effect could be muted or delayed compared to previous cycles. He also points to the Institute for Supply Management (ISM) data, a key gauge of economic activity showing extended contraction in the business environment. Normally, crypto thrives when ISM data begins to rise again, signaling expansion and liquidity returning to risk assets. But this time, the recovery has been slow, keeping the market in a state of indecision. Combined with tighter financial conditions and delayed credit cycles, these macro lags have pushed the anticipated bull phase further into the future. In other words, the crypto bull run may still happen, just not in 2025. This view has serious implications for traders and long-term investors. If Pal is correct, the market may spend most of 2025 in a sideways or choppy phase, rather than skyrocketing to new all-time highs. Instead of one massive bull surge, we could see smaller, shorter rallies followed by corrections, creating the frustrating environment for those expecting fast gains. The real momentum, Pal suggests, might not arrive until late 2025 or even 2026, when liquidity returns in full force. This timeline shift could test the patience of investors who have already endured the long bear market of 2024-2023 and are eager for the next leg up. Still, Raoul Pal's message isn't entirely pessimistic. He isn't saying crypto's future is doomed, rather, that the timing and structure of the bull market are changing. Crypto remains a transformative technology with massive long-term potential, but its price behavior is now more connected to global macro conditions than ever before. The Federal Reserve's policies, global debt levels, and money supply growth all play a crucial role in determining when capital flows back into digital assets. This evolution means that crypto is maturing, behaving more like traditional assets, and less like the isolated, height-driven market it once was. For investors, this cancelled 2025 bull run should be a wake-up call, not a death sentence. It's a signal to adjust expectations and strategies. Instead of betting on a vertical surge, traders might focus on building positions gradually, diversifying into projects with real utility, and managing risk carefully. Those who align with the longer, more complex cycle that Pal envisions could end up benefiting when the delayed rally finally comes. The worst mistake now would be to over-leverage, over-expect, or chase hype narratives in anticipation of an explosive 2025 that might never arrive. Of course, not everyone agrees with Pal's thesis. Some argue that Bitcoin's halving cycle still carries tremendous weight, and that institutional adoption and ETF flows could accelerate the next leg of the bull market sooner than expected. Others believe the innovation curve in crypto, with new narratives like AI integration, tokenization, and DeFi 2.0 will push prices higher regardless of macro cycles. These are valid points, but Pal's counterargument is clear: liquidity drives everything, and without an expansionary macro backdrop, Even the strongest narratives can stall. The emotional weight of his phrase "I'm sorry" resonates deeply with crypto investors who have been counting on 2025 as their year of redemption. It's a tough pill to swallow. But markets don't move on hope, they move on liquidity, timing, and sentiment. Raoul Pal's honesty, though uncomfortable, may ultimately serve as a valuable dose of realism. The bull run might be cancelled in the short term, but that doesn't mean it's gone forever. It just means that the market's clock has been reset. As we move through 2025, the smartest investors will likely be those who stay patient, adaptable, and data-driven, watching global liquidity indicators, following ISM trends, and understanding how central banks react to inflation and growth will matter far more than watching memes or hype coins. The crypto bull run isn't dead, it's delayed, evolving, and intertwined with the broader global financial cycle. Raoul Pal's warning isn't about fear, it's about timing, preparation, and patience. Because in the long run, those who adapt to the new rhythm of the market may still come out on top, just not as soon as they hope.